Hey everyone, welcome back to Corporate Decoder, the place where we dig into the nitty-gritty of corporate filings, and I've got something really interesting for you today. We're about to decode KT Accession's annual report for the year ending March 2025, and let me tell you, there are some fascinating numbers and maybe a few eyebrow raisers in here. You won't want to miss this, and hey, if you love getting straight up, no nonsense insights from these official documents, hit that subscribe button. We also have a fantastic community over on Discord, a link to which you can find in the description below. So let's jump right in. Accession Number, a company operating in the toy product development space, has just released its annual report for the year that ended in March 2025. This filing gives us a look under the hood at how they've been doing, their financial health, and what they see coming up. First up, the top line, revenue. For the year ending March 2025, the company reported a total revenue of about $18.6 million. This is a bit of an increase, about 8.7% compared to the previous year. It seems like sales in the United Kingdom specifically saw a nice jump, going from around $950,000 to over the United Kingdom specifically saw a nice jump, going from around $950,000 to over United Kingdom specifically saw a nice jump, going from around $950,000 to over the United Kingdom specifically saw a nice jump, going from around $950,000 to over $1.5 million. That's a pretty good boost for them. Now, when we look at the cost of revenue, which is basically what it cost them to make their products, or in this case, source them, it came in at a little over $16.1 million for 2025. This also increased from the year before, which makes sense given the revenue increase. About 85% of their cost of revenue comes from a single supplier, Fully Star Eyes. This is definitely something to keep an eye on, as relying so heavily on one supplier can be risky. If Fully Star Eyes has any issues, K-Tech could really feel the pain. This leads us to their gross profit, which is the revenue minus the cost of revenue. For 2025, it was about $2.4 million, an increase of roughly 12.6% from the prior year. This growth in gross profit is a good sign, showing they're managing their costs reasonably well relative to their sales. Moving on to general and administrative expenses, or G&A, these are the costs of running the business beyond making the product, like salaries for the office staff, legal fees, and rent. For 2025, these expenses went up by about 34.6% to nearly $1.7 million. A big reason for this jump seems to be auditors' fees, which went up almost tenfold. This is not unusual for companies going public or dealing with the complexities of public company audits. However, the overall increase in G&A does mean that a larger chunk of their revenue is being spent on these overheads, about 9% compared to about 7% last year. Now, let's look at income before tax expenses. For 2025, it was around $540,000. This is a pretty big drop from the previous year, 2024, when it was over $1 million. This decrease is mainly due to the rise in general and administrative expenses, eating into their operating income. And that brings us to net income, the bottom line. For 2025, K-Tech reported a net income of about $488,000. This is a significant decrease from the $928,000 they made in 2024. It looks like the increased operating costs, especially those administrative expenses, really squeezed their profitability this year. Let's talk cash as of March 2025. The company had about $4.3 million in cash and cash equivalents. This is down from about $5.3 million a year earlier. The report mentions that net cash used in operating activities was about $1.3 million for 2025. This is a bit of a red flag. Even though they showed a profit, they actually spent more cash on operations than they brought in. This could be due to various factors like paying suppliers faster or customers paying slower, but it does suggest a tightening of their cash flow situation. Looking at their debt, the company had total bank loans of about $1 million as of March 2025. About $184,000 of this is due within the next year, with the rest payable in the following years. While not alarmingly high, it's important they manage this debt well, especially with their operating cash flow dipping. Their accounts receivable, which is money owed to them by customers, increased to about $1.32 million in 2025. This is up from about $122 million the year before. The company mentions this is due to extending repayment periods for some customers to keep relationships positive. This could be a smart move for long-term partnerships, but it also means they're waiting longer to get paid, which can put a strain on cash flow. Then there are the amounts due to related parties. As of March 2025, this figure was about $447,000, down significantly from $2.47 million a year earlier. This shows a reduction in transactions or repayments happening with these related entities, which could be a positive sign for simplifying their financial structure. Now, let's not forget the risk factors. This section is crucial for understanding what keeps management up at night. They highlight risks, like relying on a limited number of third-party suppliers, which we already touched on with Fully Star Eyes. They also mention the risk of changing consumer preferences, supply chain disruptions, and currency fluctuations, especially since their sales are mainly in US dollars. One of the more significant risk factors they discuss is related to the PRC government's increasing oversight on overseas listings and foreign investment. While KTech operates out of Hong Kong, this regulatory environment in China can create uncertainty. Any adverse developments could significantly impact their business, and it's a risk that investors should definitely be aware of. On the shareholder front, the company's dividend policy is pretty straightforward. They haven't paid any dividends for the years ended March 2024 and 2025, and they don't anticipate doing so in the near future. They plan to reinvest all earnings back into the business for operations and expansion. Regarding executive compensation, for the years ending March 2025 and 2024, they paid out around $186,000 and $222,000 respectively in cash to their executive officers and directors. This is relatively modest for a publicly traded company, which might be expected given their current size. The company's independent auditor is Audit Alliance LLT, based in Singapore. It's important to note that PCAOB, the US auditing watchdog, is able to inspect their work, which is good for transparency. However, they also mentioned the ongoing scrutiny of Chinese companies' auditors by US regulators, and while they're not directly affected now, it's a background risk in the broader global market. In terms of cybersecurity, KTech acknowledges that their executive officers have limited experience in this area. They don't currently use third-party assessors, and so far they haven't experienced any major cybersecurity threats that have impacted their business, but this might be an area they need to strengthen as they grow. Let's circle back to the financials one last time. The drop in net income from roughly $930,000 in 2024 to about $488,000 in 2025 is a key takeaway. This is primarily driven by higher operating expenses, especially those administrative costs we talked about earlier. So what's our take on KTech Solutions Company Limited? On the positive side, they've seen revenue growth and their gross profit margin looks healthy. They're clearly doing something right to attract and keep toy brands as clients. However, the significant increase in administrative expenses in 2025, which directly hit their net income alongside a negative cash flow from operations, suggests they might be facing some scaling pains. The reliance on a single major supplier also remains a notable risk. From a Warren Buffett perspective, we're looking for sustainable businesses that are run by competent management and offer a good product at a fair price. KTech has a good product in the educational toy space, but the increasing overhead and the cash burn from operations are concerns. The management has a lot of experience in the toy industry, which is a big plus, but their limited experience with US public company compliance is also a noted risk factor. The key for them moving forward will be to manage their expenses effectively, diversify their supplier base if possible, and ensure they can generate positive cash flow from their operations are concerns. Overall, KTech Solutions Company Limited is a growing business with clear potential in the toy design development market. However, investors should be mindful of the recent dip in profitability and the cash flow situation. It's a company to watch, and we'll be keeping an eye on how they navigate these challenges. Alright, that's our deep dive into KTech Solutions Company Limited's latest annual report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.